Okay, good morning, everyone, and good Friday. I hope everyone is doing well. Today, the markets are closed, so we get to spend a little bit more time talking about the markets, but I did want to make sure that we did a market overview today because we had a pretty spectacular week on the markets, and we have quite a few of the daily play positions that I want to update everyone on, as well as just give a bit of a review as far as what's happened this week and how we should think and how we think we should be positioned going into next week. A lot has happened, so let's get right into it. So before I get started, just a quick disclaimer. What we're going to discuss here today is purely for educational purposes. This is not a solicitation or recommendation to buy or sell any specific securities. And good morning to everyone. I hope you guys are having a good Friday. So let's talk about the markets this week. We had a fair amount of optimism, a little stronger than I had expected, but also we had some news that was unexpected as far as the Fed stepping in and backstopping the debt market, which is really what's created a lot of the tailwind on this particular week. Initially, what we had was optimism that the coronavirus data that we were showing out of New York, out of the rest of the world, was starting to look better, especially in places like Italy and France, and Italy and Spain, and even German and French data that looked like they were hitting a peak. So there was a lot of optimism on that front. And then when the Fed came in and said that they were going to backstop the debt market for small businesses, that's really when this rally started to take off. So at this point, on Tuesday morning, we talked about that 273 level, which actually held quite well for quite a few different trading sessions until on Friday when we managed to break above it. So the fact that we broke above 273 is certainly a bullish view on the markets. I wouldn't quite go full boat in saying that we're going to get a V-shaped recovery, but the Fed stepping in certainly is a big help in terms of providing a reason as to why markets are this high. Prior to the Fed stepping in, I would have said that this is a great opportunity to potentially look for shorts because the economic data, the fundamental data, do not line up with where the equity markets are trading. If we look at the treasury market, if we look at where rates are expected to normalize, we're going out to 2021, 2022, does not line up. There's clearly a huge disconnect between the equity markets and the fixed income market at the moment. But with Fed coming in to backstop small businesses, that changes the game, because with fiscal policy, with monetary policy, and the Fed originally stepping in to backstop the investment grade market, that was all fine, but it still left a very large swath of the market of high yield that was not only exposed, and on top of that, you have quite a few $1 trillion worth of investment grade bonds that were likely going to be downgraded to junk status. So after all of this, what we now have is a trading range, or at least a range that I think that we are more likely to trade in. So I do think that there is some limitations as to how much higher this market can go. So far what we've had is a decline from 339 down to 218. We've retraced pretty much half of that move. So for those of you that use technical analysis or Fibonacci retracements, this certainly looks like a good temporary pausing point, if you will, and look for perhaps a small check back. I don't think we're going to revisit 235 again. I think I don't think we're going to revisit the 218 lows again. I even think a revisit of 235 lows, at this point is unlikely. But however, I will say that earnings season is about to kick in. So I want to talk a little bit about that today, but earnings season is really what I think is going to drive some of the quantitative data that we're going to need to understand where should equities be trading. And we have quite a few of those things to take a look at. The one thing I will note is on the hourly chart, as we pushed higher here on Friday, momentum did not continue to move any higher. And that's part of another reason why I think this market might stall, at least for the next few trading sessions on Monday and Tuesday, just like we had seen in the prior run up here, where we were making higher highs on price, but momentum was continuing to make lower highs here. And then we get that subsequent sell-off. I'm expecting something similar to that, maybe pull back to that 260, 262 level. Not a huge pullback, but a small pause here in this particular rally based off of the hourly momentum charts. So that's where we currently stand with the market. Let's take a look at some of the data. So most, when we had this rally starting on Tuesday, again, this was based on some of the encouraging data that was coming out of the New York hospitals, and predominantly around the fact that even though we were still growing in number of new cases, even though there were still higher new deaths, the rate of which that was happening at was lower. And that was the optimism that we are at least winning the fight, even though we are still maybe perhaps a few days to perhaps a week from the peak. But the fact that if we're winning the war, then that is a great piece of news. And that's what the markets rallied on. And then you add to that the Fed backstopping the debt markets. That's really what caused the strength that we saw here on Friday. But it's really interesting to also consider, where did we see strength? We didn't see strength across the board. Predominantly, we saw a lot of utilities, a lot of financials, a lot of real estate sector up 4-5%, while the other sectors are up 1.5%, 2%. Technology not particularly strong, which was an interesting thing to keep an eye out on. And I think what this provides us is a lot of opportunities going into earnings season. But as you can see here, Italy and Spain peaked right here about a week and a half ago. France and Germany also, at least at this point, not continuing to grow, which is good news. The only concern that I have is, these are the four countries that are in the forefront, but there's plenty of other countries behind this, a few days, a few weeks, and countries that do not have the same resources that these countries have to fight the coronavirus. So I don't expect this to be a quick and fast recovery. I think that you're going to continue to see pockets of coronavirus pop up, perhaps even countries where they open their borders or reopen their economy a little too soon and then see a resurgence of COVID. These are all concerns that we have. Most of the models that's showing that New York City is likely reaching their peak at this moment is still assuming that this city remains locked down till the end of May. So that's still about a month and a half from now, a little more than a month and a half. And the question is whether or not our governments will actually agree to that. And it seems like countries that do, like Italy and Spain, are able to contain this fairly well. So it's yet to see how the rest of this particular country deals with it. I do think New York has taken a slightly different approach than some other places like Florida. So a lot to still watch on this particular front, but again, we're seeing good news come out of this. We're seeing the news that despite the fact that we haven't reached the peak, that we are making good progress in slowing down the spread of this virus. So that's the good news here. The important thing that I think we need to start paying attention to, and the reason that we didn't pay as much attention to prior, is because we just didn't have the data. Unfortunately, economic data comes out relatively slow. The one piece of information that we do have that's fairly real time and fairly frequent is jobless claims. The unfortunate part about jobless claims right now is the fact that we're seeing about 14 million unemployed. Granted that 80% of those 14 million, at this point, they are marking down that they expect that their unemployment is currently temporary. The question is, how long is that temporary unemployment going to last for, and how many people are going to be temporarily unemployed? And then more importantly, when we open back up our economies, how quickly can these jobs be filled? 14 million people, just to put into perspective, that's the whole population of Texas. So we're talking about a very, very large percentage of our working population out of work for at least 2 to 3 months time. And arguably after those 2 to 3 months time, it's not exactly like all 14 million people are going to be able to go back to work immediately. It's going to take some time. There's going to be some hiccups. Looking at China, things are not back to normal in places like Wuhan. So it's yet to see as far as how that's going to look like. So I think between now and the end of the year, there's going to be a fair amount of volatility that we're still going to see around economic numbers that come out. So non-farm payroll that come out every single Friday, the first Friday of every single month, I think is going to be a very important economic data point to look at every single month. But again, that's data that lags quite a bit and only comes out once a month. But I think we're going to have to go back to really paying attention to those types of numbers every single week, as well as unemployment claims. GDP forecast at this point, Q2 is looking pretty bleak. We're looking at roughly 25% decline in GDP in Q2. Most forecasts right now are still looking at a positive GDP in Q3, which I think is likely going to happen, but the net for the whole year is still going to be negative. The question really is how negative, meaning how much of a decline do we see in Q2 and how much of a recovery do we actually see in Q3 and Q4? My hunch is that Q3 is not going to be as strong as we would like it to be or anticipate to be. Q4, likely we're going to see a pretty strong resurgence in Q4. But again, year over year for the whole year of 2020, we're likely going to see a negative return on GDP. So how do we trade this market? I want to talk a little bit about the strategies that we're focusing on. I want to show you some of the data sets that inform our decisions as to why we use these types of strategies at the moment. Just like everything that's happened in the last few weeks, things are changing very quickly. So what is applying today and tomorrow may not apply the next week. So at the moment, due to the highly elevated implied volatilities on individual stocks, generally speaking, we want to focus more on selling premium. But I wanted to show you some caveats here as far as why just selling premium across the board is not necessarily the right strategy. You have to be very careful when you're thinking about selling premium. So first of all, elevated implied volatilities means that selling premium, generally speaking, is a strategy that you want to employ. This could be credit spreads, this could be cover calls, this could be short cash secured puts, but I want to discuss on the next slides what to look for if you're going to be selecting from these types of strategies. VIX backwardation, it seems to be normalizing. So VIX 1 month versus VIX 3 month currently are trading just around the same level, around 41. If VIX 1 month can go below the VIX 3 month, that would be more of a risk on environment. Currently, we're still below that. We're still above that 3 month VIX level, which is telling us that we're still in a bit of a risk off environment at the moment. Liquidity has continued to improve, not by a whole lot. We have 145 liquid optionable symbols right now versus 55 2 weeks ago, 130 or so last week. So slowly liquidity is improving, but still far from normal, where we normally see 300 to 400 names on this particular list. So strategies I want to focus on here today are selling credit spreads. So credit vertical spreads for stocks that you have a bullish or bearish view on, or sectors that you have a bullish or bearish view on, and selling cover calls on stocks that you have existing stock positions in, especially stocks that you own from a higher price and you want to generate some income while you wait for this market to potentially trade fairly sideways for the next few months. Especially going to earnings season, I expect there to be a fair amount of volatility, fair amount of stocks moving higher, fair amount of stocks moving lower. I'm really curious to see how earnings kicks off next week, and we actually have a special event just for that. So I hope those of you that are able to join me next Thursday are able to join me as we take a look at the earnings calendar, take a look at the earnings that have played out, and see how to go about trading that. So the chart that I want to point you to is implied volatility. So many of you have used implied volatility in some way, shape, or form in your trading. For those of you that are brand new to options trading, this is something that I will be covering in my intermediate options course. But for those of you that have some experience trading options, you might be familiar with the concept of selling vol when implied volatility is high, and buying vol or buying options when implied volatility is low. And as a general statement, that is generally true. However, what isn't apparent when you're looking at just implied volatility is the skew, meaning how are options trading in relation to each other within the same expiration date. So here is a chart of Microsoft call implied volatilities and put implied volatilities. And just for a reference here, the current stock is trading around 165. So this is the at the money strike price on Microsoft. And what you'll see immediately is that in this particular case, the in the money calls for Microsoft are actually trading at a higher implied volatility than the at the monies. And the out of the monies are trading at a lower implied vol. So here is the in the monies, here are the out of the monies, and here are the at the monies. So you have to remember that when you're trading these, you have to think about whether you're trading an option where you're buying in the out of the money or you're buying in the money to determine exactly what type of strategy that you are trading. Oh, whoops, sorry. This is out of the money. This is in the money. And this is out of the money. And this is in the money. So the reason I want to bring this up is because if let's say I'm looking at this particular, I'm looking at Microsoft, right? And I tell myself that I want to sell credit spreads because implied volatility is high. But what you'll notice is that if you do that, it depends on whether you're taking a bullish or bearish view as to whether or not credit spreads make sense. So let's say you're bullish on Microsoft. So what you have to do is you have to sell the at the monies, which is good that implied volatility is high. You're going to generate a higher premium. But then what do you have to do? You have to buy the out of the money puts against it to offset your risk or reduce your risk on the overall trade. But guess what? When you're buying this out of the money option, you're paying even a higher implied volatility, which really negates the whole purpose of selling premium when implied volatility is very high. So these are the nuances that we're currently seeing in the options market that actually make it difficult to always sell implied volatility, especially even though volatility is high. Vice versa, if you were taking a bearish credit spread position here on Microsoft, that is when it actually looks quite good, because here I'm selling an at the money call option, which is fairly elevated. It's trading at 40% vol. Normally Microsoft is in the 20s. So getting 40% vol is very good. And then I have to buy an out of the money call option to reduce my risk on my call vertical credit spread. And here I'm paying even lower implied volatility. So here, this is the most ideal credit spread where you're selling something that's relatively high, buying implied volatility that's relatively low. So what you immediately see is that you have an edge here when you're selling a bearish credit spread on Microsoft, but you actually lose that edge if you're trading a bullish credit spread here on Microsoft. And if you just look at implied volatility rank or percentile or any type of implied volatility metric that many of you may use in your trading, you're actually missing this one piece of very important information as to whether you have a edge on the bullish or bearish side. Vice versa, if let's say you're buying premium, and we all know that when implied volatility is high, you generally want to avoid buying premium. But here in this particular case, even though if I'm trying to buy a bearish put spread on Microsoft, yes, I'm paying a lot of premium on the at the monies, which is normally what I would buy, but I'm able to sell something that's out of the money that has even higher implied volatility. So what that does is that even though I'm paying a high amount of implied volatility, I'm able to negate quite a bit of that by selling something that's even higher implied volatility. So even though implied volatility rank or percentile here is very high for Microsoft, I'm still able to take a debit spread. I'm still able to buy options here. So I just want to make sure that people see this before they start trading, and don't just assume that if volatility is high, I'm going to go out and sell, or if volatility is low, I'm going to go out and buy it. There are some nuances about volatility, and this is something that I'm going to teach in my intermediate class where we talk about volatility a little bit in depth, because again, I think that many traders, they see high implied volatility or low implied volatility, and you immediately gravitate towards one strategy over the other. Be careful when you do that, because volatility is really just more of a generalized term. You're not seeing some of these nuances of volatility, which affects the efficacy of your strategy. So with that said, let's now jump over to a few things. So I wanted to first talk about some of the daily play positions. So we've taken a fairly, I would say, bearish view in the markets 2 weeks ago, where we entered some Nike shorts, some GM shorts, some SPY shorts. And then we have our long positions. We have our T-Mobile, XLV, which has been doing quite well. We are short Square. So we have taken quite a few of these short positions, of which, as the markets has risen, has rose, have obviously underperformed. So I want to talk a little bit about how to play these, particularly at this point. So first of all, I will say on a trade like GM, where the markets are, where the Fed has come in and backstop some of these debt markets for automobile companies and provide potentially bailouts for these companies, I think it's time to cut these losses and simply move on. But I still believe that there are quite a few of these trades like Nike and Square where we're talking about in the consumer space. And if we look at the fundamentals and we look at the underlying data of credit card spend between Square, which predominantly is in the credit card space, and Nike, which is one of the largest consumer brands, the numbers don't add up to where the stock is currently trading. So for those of you that feel that the markets have recovered, that we've broken out above a resistance level and it's time to start looking for bullish opportunities, you're looking at what stocks should you buy, my suggestion to you is simply cutting your losses on stocks like Microsoft and Square and continue to hold on to trades like GILD, T-Mobile, XLV, these types of trades on this particular market. If you agree with me that there's a disconnect here in the markets, that we've rallied a little bit too far, we've managed to retrace 50% of the initial sell-off, but you look at the economic numbers, you look at the fundamentals, and you say something doesn't quite add up here. There are a few different things that you can do. We can try to roll out these calls to, these puts to a longer dated strategy. Square is down roughly about 50% right now, so I do think that if we don't see some weakness in Square in the next week, I would consider cutting my losses on that. Square, I think Square, one of the reasons we entered Square was just because of the sheer amount of exposure they have to small businesses and to restaurants, which are some of the hardest hit businesses in this particular environment. But again, with the Feds coming in to backstop the small businesses, that's really where we've saw a huge rally in Square. That news unfortunately came out after we entered that position. So a lot of things have changed from a fundamental perspective, but again, the numbers from my perspective do not add up to where the markets are currently trading. So I wanted to update everyone here as far as what our positioning currently is, how we're thinking about these trades, and how we want to position ourselves going into next week. So earnings season kicks off next week, and I'm going to be doing a special event on Thursday. So the normal Thursday afternoon webinars, we're going to be doing an earnings preview event where we're going to be talking about how to go about trading earnings. We're going to be looking at the earnings calendar, which is something that we also recently launched, so that I'm going to show everyone kind of what this calendar looks like, how do you go about using it. But I'll just give everyone a quick preview here. What it does is it shows you the upcoming dates. We have a sector telling you what sector is predominantly providing earnings, are releasing earnings that particular day. And what we've done is we've listed all the stocks that are reporting earnings that day, and we've organized it based on liquidity, so that you can see JPM and J&J are the most liquid options on the 14th, UAL, United Airlines, the second most liquid, and then everything below that are kind of more of the smaller cap, less liquid names, so that you have more of a focus on the big names. I will say that if you're trading earnings, you generally want to stick to the more liquid names. The smaller cap names, you're going to find implied volatility is very high. You're going to be paying quite a bit on the bid-ask spread to get in and out relatively quickly, which for earnings, you generally want to get in and out very quickly. So when I trade earnings, I would usually stick to these types of names. Anything outside of that, I generally don't particularly trade. So, it's really important for us to use a calendar like this that is organized based on liquidity to know where we should focus on. So we know who's reporting what, when, what type of stocks are trading, are reporting, because, earnings season goes in I would say, spurts in terms of the different sectors. So it's important to know what sectors are coming up. So we provide that as well as a listing of this. We're going to go over all of that on Thursday. It's at our normal 4:15 p.m. Eastern time. So I just want to walk you through some of the themes that we're currently taking a look at. So large banks, one of the reasons we're looking at large banks is because they report pretty much first out of the earnings seasons. And many of these are trading below their book value. They're actually, the balance sheets for some of these major banks are looking substantially better than, they are substantially better than during the financial crisis. They don't have the same type of toxic assets on their books. So if you look at some of the names like Citigroup, Goldman Sachs, Bank of America, these are banks that have strong balance sheets, that are trading below their book value, that have a fair amount of trading exposure as well, because trading exposure is really one of the brighter spots in the banking industry. And only traditionally the large banks have large trading operations. The small regional banks generally have limited trading operations, so they don't have any benefit from higher trading volumes. So as this volatility picks up, trading volumes picked up, as spread widened, a lot of these banks have made some money on that. So it offsets some of the losses that they've seen in the interest, in terms of the amount of interest that they own, which is predominantly their main revenue driver. We've seen some of these banks, their stock price be cut in about half. But we've seen quite a bit of rally in stocks like Citigroup, Goldman Sachs, Bank of America this week. So, at least from an investment perspective, the fact that they're trading below their book value, they have strong balance sheets, and we have an estimate as to when this will all end. I think these are potentially some stocks that you might want to take a look at. These are names that, if you're looking at owning them, I think selling put options are ideal, because selling put options on stocks like Citigroup, you're going to generate quite a bit of yield, trading at 47 bucks right now. If we go to our income tab and we look at short puts, I can sell a May 1st $43 put, collect $177 on that for every 100 shares, which is 3.73% of the underlying stock price in just 3 weeks. You're generating almost a 4% discount on the stock purchase if you were able to purchase this by selling a put option as opposed to buying the stock. You can get even more aggressive if you really want to own the stock and sell maybe a $45, collect $2.16, which is almost a 4.5% discount. So depending on how aggressive you want to get, think of selling a put option like placing a limit order, right? So where do you want to buy the stock? Would you place a limit order at 45 bucks? If you would place that limit order, I would suggest that you instead consider selling a put option that generates $216 in income for every 100 shares, which equates to almost a 5% discount on that stock purchase. And worst case scenario, you don't get filled and the stock keeps rallying, you at least have about a 5%, income for the next 3 weeks to show for that capital that you're putting aside to try to buy that stock. So as far as the banks go, that would be the type of strategy that I would be looking at. Airlines, a lot of questions about airlines, and part of it is because they report earnings, and some people are asking, should I take a flyer here? Should I buy some out of the money call options? You certainly can. However, I will say that the data currently shows is that the new airline data that we're looking at, we've seen a new all-time low in passenger traffic. We've just hit this week below 100K average passengers per day. Normally we average about 2 million. So we're looking at about a 95% decline. That number is still continuing to decline. So my hunch is that it's not quite time to get into it. But if you do want to take a look at, taking a flyer here, it seems like a lot of people are trying to buy some out of the money options, seeing if this stock makes a big move. The report's earnings on the 16th. But as you can see, options are really expensive. Even if you go out to January 2021 and you buy something out of the money like a $35 call option, you're paying $3.15 on a $24 stock. So you're paying well over 10% for this really far out of the money. You're talking about an option that's roughly 33% out of the money. You're paying 12, 15% of the underlying stock price. This is really taking a flyer, as I would call it. So for those of you that want to take the risk, the odds don't look particularly good. The fundamentals don't look particularly good. But if you get some decent guidance, which I don't anticipate that you're necessarily going to get, if you're going to get some decent guidance, that's where I would consider perhaps stepping into some of those airlines by other strategies. But again, I don't think I would be touching those stocks at the current moment. I unfortunately think that you might see some bad news coming out of those earnings announcements next week. But again, this is why I'm really excited about earnings season. It gives us another focus to look at. It gives us, I don't want to continue looking at coronavirus data. I'll be perfectly honest. I'm sick of looking at coronavirus. I want to take a look at some companies. I want to take a look at their guidance. I want to take a look at some of their numbers. That's going to help me provide a bit more guidance as to how we should position for this market. Lastly, I want to take a look at some exchanges. Another bright spot a bright spot that's in the market. Exchanges, generally speaking, are recession proof for the most part. They generally don't see the same type of declines during a recession as most other financial institutions. However, exchanges happen to have benefited from the recent market volatility. Trading volume is up. NASDAQ, SIBO, ICE has seen about a 10 to 15% bump in trading volume. So those stocks are actually doing fairly well. And so those are some of the stocks that, if you're thinking about selling some put credit spreads, thinking about buying as a trade, those are some of the stocks that you can take a look at. NASDAQ trading fairly close to their February highs here. Right before the sell-off was trading around 114. It's back up to 107. These are stocks that have benefited from the increase in transactional volume. Intercontinental exchange, very similar. Before that sell-off, in the 95s, now trading at 87. So looking at these types of stocks are interesting ones to pay attention to, especially going to earnings season. But, really looking forward to seeing how some of these technology stocks perform. If you look at technology, what's interesting is that XLK has not actually performed particularly well. It was actually flat on the day yesterday when markets were higher. This tells me that technology does not come out of this as strong as it did going into this, partially because a lot of technology stocks have fairly weak balance sheets. They rely on high growth, granted, they're not as susceptible to unemployment as some of the other sectors, but they are heavily dependent on venture capital, fairly dependent on private equity and other forms of funding that have dried up as a result of this. So it's just a sector that has generally much weaker balance sheets than many other sectors, such as in the staples space. Consumer discretionary, also fairly large number of companies with fairly weak balance sheets. Energy, also still the only sector that was down on the day yesterday. I really think that the energy sector is one to try to stay away from right now, given everything that we see. Crude is actually back to below $25. And this just tells you the challenges that are ahead for the energy industry. We've already had one bankruptcy. I expect to see more, and there's going to have to be mergers for different firms to survive going forward. So that is what I wanted to discuss with you here today and show you what we're currently looking at. What I'll do at this point is, because the markets are closed today, I'll take a bit more time to answer questions, any symbols that you might want to take a look at. Before I do, I just want to remind everyone, if you are brand new to OptionsPlay, if you don't have access to this platform that I just showed you, and you don't have access to the trades that we're sending out every single day, you can sign up using this link here on your screen, which I will post into the chat window. This is for those of you that do not have an OptionsPlay account. This gives you a free 30-day access to the tool. Afterwards, it's $75 or $500 a year. And for those of you that are already on a trial, I hope that you consider supporting us and becoming a member, which is just, again, $75 a month or $500 a year. It gives you access to all of the tools that we're showing you here today, as well as the earnings calendar, liquidity reports, all of these things that are designed to help you better understand how to trade options. So with that, let's look at some of the questions here. I know there's quite a few. Edmund, you're very welcome. Jim, does the Fed backstop moves have to pass Congress? No, the Fed is completely an autonomous entity. Interesting, if you want to read more about the Federal Reserve, read about the history, how it's formed, the fact that it is not a government entity, and they do not report to Congress. What does backstop mean? It just means that they're providing loans to small businesses that normally would not be able to get loans at these particular rates. Meaning, if these small businesses were to seek loans on their own, they would be paying a substantially higher interest rate, or perhaps not even be able to get a loan for this particular size. Where the Federal Reserve is stepping in to do $2.3 trillion, not a small amount of money here. Where's the UK trend line? Great question. I'm not 100% sure. Let's take a look. These are all publicly this is all publicly available data that everyone can have access to. UK here is looks like 6th or 7th down on the line. Jim is saying, how is SCW created? Market makers, supply and demand. Jim, if you don't mind, what is SEW? Looks like, at this point, looks like UK is still clearly on the rise here. A single day decline really, I think, doesn't mean a whole lot, because you can have multiple days of decline and then a move higher. We've seen that multiple times in Italy. We've seen that here in the US. The US has had 3 basically consistent days of roughly 1,900 deaths per day, which, the fact that it has an increase is certainly good, but that doesn't necessarily mean that it won't, reach another peak, tomorrow or today. So we've had 3 days of just roughly around 1,900 here in the US. Hopefully that this continues to move lower and that this 1971 is the peak. But again, a little bit too early to tell, but hopefully that's the optimism that I think the market is currently trading on. I'm buying deep in the money calls, paying very little implied volatility. If for those of you that are long-term investors, that is definitely one of the better ways to offset implied volatility, is buying deep in the money options. Well, actually, I don't necessarily think that you need to go deep in the money, because as you can see here, in quite a few of the cases, the deep in the money calls are actually trading at a higher implied volatility. Granted, the further out you go, so this is the May versus the Junes, the further out you go, the less steep this curve is. But we have seen that the in the money calls are actually many times trading at a higher implied volatility than at the money. So I will say that if you want to be a long-term investor in a stock, you want to do it utilizing leap options, I would advocate that you use something that's closer to the at the money strike rather than something deep in the money in a bid. Jockeys is asking, what chart do you use and what are your settings for displaying implied volatilities on Microsoft? So I use this chart I pulled off of Thinkorswim. Any type of volatility type of platform would be able to provide that to you. Some of you might use iVolatility, some of you might use LiveVol. There's and many other brokerage platforms provide this type of stuff. And what I'm looking at is just 2 expirations, and I only use 20 strikes, meaning I'm not looking at the full strike. I tend to find that if you're looking at the full strike, you see a lot of wackiness on the really far out of the money options or really far deep in the money options. So I'm only displaying 20 strikes here. So, pretty much a good chunk of the at the money versus the out of the money options. So that's what I'm using here to display that. Miguel is saying, I don't understand much of what you're saying. I need to take one of your courses. Miguel, thank you so much for saying that, because at the end of the day, options trading is something that does take time to learn. And that's why we do weekly education every single Thursday, where we teach different option concepts. If you managed to catch us yesterday, we do this every single Thursday so that you have the educational content to learn. You can follow us on YouTube. I recommend that those of you that are in the process of learning how to trade to follow us on YouTube. We have playlists created for you. I just posted a link. I highly recommend you to follow us on YouTube so that every time we post a link or post a new video, you're able to catch up on it. And we organize everything for you so that you have a better understanding as to how to go about that education. Hi, Tony. What are your views on AbbVie? So AbbVie I will say that out of the pharmaceutical companies, I haven't been following as strongly. But if you look at the chart, very similar to many of the other ones, what's interesting is that AbbVie has a pretty major resistance level here. So I would wait just a couple of trading sessions and see if it can peak higher. If it can break out above that level, I think I would be much more confident and long on this particular trade. Very strong relative strength. So, and overall, overall, I really like the healthcare sector, but I prefer to express my views right now through the sector itself rather than individual names. I think you have too much risk on the individual names because there's a lot of pharmaceutical companies in the running for creating some kind of coronavirus cure or vaccine, and most of them will fail. And I certainly don't have the ability to predict which one will succeed and which one will fail. So I would prefer that I would buy the whole sector and not take on the individual stock risk for healthcare. Richard saying, what about SPY trade? If you don't mind clarifying what you mean by that question, I'm happy to look at that. Francois is asking what time on Thursday. You can join us every single Thursday at 4:15 p.m. You can sign up using the link is optionsplay.com. I'm sorry, trade.optionsplay.com/learn. I just posted that link into the chat window for those of you that want to sign up for our Thursday webinar coming up for the earnings season. Let's see, a lot of questions. How would you set up new trades on Square and Nike if we didn't get in when you did? So if you agree that the consumer market is, at least the credit card data that we're looking at shows that there's been a significantly decrease in spend across small businesses, clothing stocks, and that's a thesis behind being short Nike and Square. I think the difference that what I would do now, well, first of all, I don't think that I wouldn't get into Square anymore, given that the new Fed backstop for small businesses is in place. I'm not as bearish on Square as I am. Nike, I still I think what I would do is instead of buying put verticals, I would sell call spreads. So what I would be doing is I would basically say, well, I think $90 here is a fairly strong resistance level here on Nike. I would sell a credit spread here to basically defend that $90 level. So as long as the stock stays below, below 90 or so, then I'm able to take profit on that particular trade. Maybe something like an 87, 92 call spread, a $5 wide spread collecting $2.33, well above the third of the width. So normally when we sell credit spreads, we try to collect a third of the width, which here would be about $1.60. $1.67. Here I'm collecting $2.33. So this is taking advantage of that skew that I was showing you here before, where what I'm doing here is I'm selling now obviously it's not on Microsoft here, but what I'm doing is I'm selling the at the monies, which are fairly elevated, and then I'm buying an out of the money call option that I'm paying very little for. So what I'm able to do is I'm really able to maximize the high implied volatility that I'm able to do. So that's the way that I would play Nike now if you didn't get into the original trade and you agree with my thesis that the consumer market seems to have rallied a little stronger than what the fundamentals show. And perhaps you might want to find a name other than Nike. Right? Nike certainly is one of the strongest names in the consumer space. That was my thesis, is that it rallied a little too far, too fast. Markets so far has proven me wrong at this point. But if you agree, you can certainly take a look at Nike. You can also take a look at some other consumer brands that you think have weaker balance sheets, that don't have the same brand recognition, that that may have a tougher time getting back on their feet. I certainly don't think Nike is in the camp of having a tough time getting back on their feet. What about HSBC? I have not looked at HSBC. HSBC technically is a bank listed, is a London bank. I don't follow so much of the European banks. I follow predominantly the US banks. Nayli is asking, when selling a call, what do you do if you want to own the stock? When selling a call, so you only sell a cover call if you own the stock. but the put you sold is not exercised. When selling a call. So, you know, one of the things that you can do is if you want to sell a put, but you also want to take advantage of the upside, is you sell a put and then take the proceeds and then buy a call option. That's what we call a synthetic stock position. So you can take the $212 here by selling this $82 put and then go out and buy a call option with it, so that your net credit on this may be close to zero, but you get both the upside and the potential to own the stock. You're just not getting much premium on that. Taking a flyer, pun intended. The pun was not intended, but now that you bring it up, you know, I certainly should have. Mora, would the airlines benefit if there's a big stimulus from the administration? So, I mean, we already know that there's going to be a stimulus for the airlines. $50 billion was the package. The question is there going to be a bigger stimulus? If there's going to be a bigger stimulus, absolutely. But again, you know, right now, what's really more uncertain about the airlines is whether or not people are going to get back on a plane. I know that if let's say we open up our economy at the end of May, and I have to take a business trip, you know, in June to go somewhere, I'd be a little hesitant to get on that plane. I'd be thinking about what protective equipment that I might need, who I'm going to be sitting next to, wiping down the seats. I'm certainly not, you know, and I fly a lot, and I would say that I wouldn't be jumping on a plane at the first possible chance. So I think that's really your biggest concern. I think business travelers will get back on planes much quicker, but I think tourists will very likely not get back on planes for a bit of time. GLD. Actually, this is a great, thank you for bringing that up, Key. GLD, very interesting. Back up to 158 all-time highs, or not all-time highs, but relatively recent highs. And, you know, with the $2 trillion stimulus package, with $2 trillion initially that the Fed has agreed to purchase, and now another $2.3 trillion that they're going to pump in the system, you know, inflation is going to be a real concern going forward. And gold is generally considered as a hedge for inflation. So GLD, very interesting trade, I think, to make right now, especially if we get a break above that 158. I think that if we do break above 158, which I think we are likely going to do, you're going to see some decent moves in gold higher. Now, another one is really the gold miners. The gold miners will give you many times a little bit more leverage on the moves on gold. These are very, very volatile names, so be careful when you venture into these. I think the only way I would trade these is utilizing options. Barrick Gold trading near its all-time high at 2250. So very interesting sector to take a look at. I'm certainly paying attention to gold here. Long is saying, I own 200 shares of Alibaba. How would you trade Baba if you were in my shoes? I would sell cover calls on Baba. You know, I mean, at this point, I don't necessarily see a whole lot of upside on these particular stocks. So you can generate a fair amount of yield here. Now, Baba in this particular case does not generate a whole lot of yield. But let's see, yeah, so even at the midpoint, you're really not generating much yield here. So unfortunately, Baba, and this again goes back to my chart here. And what we're seeing in a lot of names is that, and this is not true for all names, but we are seeing in some of the names is that when you sell these out of the money call options, so this is the at the money, this is an out of the money call option, is that you're not getting a lot of implied volatility for it. So, you know, it really depends on whether you continue to want to hold Baba. If you do, then I would sell cover calls. Not a lot of premium in that particular name at the moment, but hopefully this normalizes a little bit more as the at the monies come down, the out of the monies will generate a little bit more premium for you. Should we be selling weekly puts against our long September 255 puts? Absolutely. So that's one of the question is, you know, these 255 puts that we own for September, should we be selling weekly puts against this? I think selling the 255s, perhaps even a slightly higher put option, just that if you sell a higher put option than the 255s, you're going to have to post some margin for that. But I think your risk is relatively small. I think selling the 255s, 260s are all reasonable strikes to sell weekly options. If you continue to do that, you can really offset a lot of the cost of the long call here. I'm sorry, the long put here. Great question, Rick, sorry. Alan is asking cost of options exercise on OptionsPlay. So we are not a brokerage firm, so there's no cost on our end. You have to talk to your broker. Most brokers do charge an exercise fee. There are a few now that don't. So if you want to explore those, you can certainly look those up. Are technical scores bullish in OptionsPlay, for instance? So a technical score is relative strength, right? So it doesn't tell you that it's bullish. It just tells you that if the markets move higher, it's likely to outperform. If the markets move lower, it's likely to outperform the market. So, you know, when you have strong relative strength, that just means that when the market moves down 50%, this stock is likely to move down only 30%. It doesn't mean that it's bullish. So that's a very important distinction. The 1 month and 6 month trend, however, provides you with more of that directional view. The relative strength, the technical score tells you more of a relative strength view, meaning whether it's going to outperform or underperform the market. It doesn't tell you whether the market's going to go higher or lower. When you roll a near the money credit spread that has gone against you for the credit, is the realized loss recovered when the rolled options expire in your favor worthless? When you roll a near the money credit spread that has gone against you for a credit, is the realized loss recovered when the rolled options expire in your favor? Yes, the answer is yes. However, you may not recover all of your losses though. So, you know, when you roll a credit spread that has lost money, the credit that you receive on the new credit spread may not offset the losses on the first trade. But to answer your question, it is realized when you when the second option or the second credit spread expires worthless. Akash is saying, for airlines, does it make sense selling puts? So let's take a look. I'm going to use Delta. I'm going to use Delta simply because it's the airline that I fly. It's the airline that I'm just going to use as a proxy for the airline industry. So selling a May 1st $22 put collects $120. That is 4.92% yield. Not bad. A 4.92% static return. Not bad. But you know, if we look at the short put report. Now, this is something that also I think is worthwhile to look at for those of you that are interested in selling puts and calls. We publish this every single Monday. We send it out to you in the morning. And, you know, let's see, American Airlines this was on Monday, and we'll update this again on Monday. You know, American Airlines at the time, trading at $9, selling the $9 put, generated a 20% static return. So United Airlines, this was on Monday, so these numbers obviously are a little different now, 18% static return. So right now, if you saw in Delta, it was about 5% static return. So certainly a lot of that premium has evaporated, I would say. But I would still 5% static return, I think, is pretty good on that. But I would take a look at this report and see if there are any other stocks that you like better from a fundamental perspective. I just do not like the airline industry from a fundamentals perspective. So I wouldn't go out there and sell puts yet because I'm not comfortable buying these stocks at the moment. But if you are, 5% static return certainly is significantly higher than normal, but you might find that there might be other names on this list that you think from a fundamental perspective look stronger that you would rather buy than Delta Airlines. I just think the airlines are a little bit too precarious. You know, even something like Ulta Beauty, some of these consumer brands that are likely going to get back on their feet fairly quickly, you know, giving you 13, 14% static return. You know, I would be more comfortable buying UHS, some of the hospital groups, GE. These are all ones that are going to provide, I think, a better return. On SPY, are you guys doing midweek options trades, or are you going out looking out far out? Generally, I would say for SPY, my views are more longer term right now. Shaila's asking, could you please clarify your thoughts on existing versus new positions? Like in my case, I have significant long-term gains on existing positions and wonder what the best strategy to protect gains while generating income. Well, if you have long-term positions like stocks, the only strategy really is selling cover calls. and that generates income. And I think that's a strategy that you should utilize in this particular market environment. I've been buying leaps and selling calls. Do you use that strategy? Yes. However, the problem with buying leaps and selling calls is that if the stock goes above your strike price with a short call, you have to buy back that short call. And in this type of market environment, if if you've bought some call options on, let's say, some really depressed stocks, and they make a big move, you might actually lose quite a bit of money on that short put that offsets more than the gains that you have in the long call. So as long as you're aware of that risk, you should do it. But I would, I'm more inclined to do them instead of on leaps, but maybe on like 6-month options rather than on leaps. How about a long call on AT&T? So interesting strategy. So AT&T certainly is, out of the telecoms, I really prefer T-Mobile over AT&T and Verizon. I think as we head into a recession, as people are more price sensitive, that they are likely to move towards a telecom that is more customer focused, more price sensitive to their customers. And I think, the expectations right now is that T-Mobile is going to see roughly double the type of new subscriber growth as AT&T and Verizon is going to. So I'm not as bullish on AT&T, but buying a call option, as you can see here, is quite expensive. So I'd be careful about buying that call option, even if you go a little further out in time. It gets a little better, but it's still quite expensive in my opinion. Paying $194 on a $30 stock, you're paying 7% of the underlying stock price. Not cheap. When you have an option of a stock, do you receive the dividend of that stock? No, you do not. Any views on the SPY major levels for next week? So the main one that I'm going to pay attention to is still going to be the 273s. You have some minor resistance up here around 283, so you might get a push up to there, but we kind of pushed up there to around that 281 level intraday on Thursday, and then pulled back, almost sold off to the lows, but kind of came back in the middle. So very curious to see how market opens up on Monday here. I'm curious to see if 273 will stay as support. If it stays as support, then I certainly think that we are in a much better position from an equities perspective. But again, I will say that I see a fair amount of disconnect here with the equity markets and how optimistic the equity markets are compared to the other markets at the moment. What are your thoughts on HYG? So HYG, moved significantly higher on the news that the Fed was going to backstop, these smaller businesses or more non-investment grade businesses, the $2.3 trillion. So, this is an interesting chart to look at is actually HYG versus LQD, which is high yield versus investment grade. And for the first time, we saw HYG kind of pop higher. So, this is good for the stability of the markets when both high yield and investment grade sees stability, and I think this is a big part as to why the market is rallying at the moment. But HYG, I would say that would you still go along HYG now after it's popped 6.5% in a single day? I would wait perhaps for a little bit of a pullback, but I think now it's time that you can start venturing into these if the Fed since the Fed is backstopping these markets. What do you think about STZ? I don't know much about STZ, to be perfectly honest, so I'll take a look at the chart. Let's take a look at STZ. I know that alcohol is doing fairly well, especially when bars are closed. People have been stocking up on liquor, but I do think that people have been stocking up on liquor a little bit more than the beer category. But I don't have a lot of data on that. The chart looks very similar to most of the other charts out there. I will say again, just like many charts, what you're sitting up right now is against some major resistance. So if you're going to go long, I would wait for that stock to move above it. But chances are you're going to get, I think, a temporary move to the downside from that resistance level. I think I just talked about HYG. CCL, same thing as like the airlines. I don't think I'm touching any of the cruise lines at the moment. Some of you might be willing to take a flyer on those types of names, but not for me. What's the better strategy now, debit or credit? I think I just explained in my presentation that credit spreads have the advantage here, but be careful, not all credit spreads are the same. Can you expand on delta trade? You mentioned previously buying the 40 calls and sell close calls repeatedly. Oh, so the question is, it's a calendar. So if you are going to venture into something like delta, I think the best way to do it, I wouldn't do this 6 days going into earnings. I would do it after earnings if you think that the stock is going to recover, is you buy a diagonal where you're buying a long dated call. Let's say I buy a, I don't know, January 2021 call option and I sell short dated options against it. Maybe I sell a $30 or $29 call option against it, pay $6.70 for that January call, collect $64 cents for the April calls, and basically hope that the airlines kind of slowly grind their way higher. So as they grind higher, I'm collecting roughly 10% of the underlying call price in 14 days. Again, I would do it after the earnings announcement comes out so that you have the ability to do this so that you're able to chip away at the cost of that long call over a long period of time. Could you post a link to the earnings spreadsheet? Yeah, so it's just trade.optionsplay.com/earningscal. I will post a link to everyone here in the chat window here in 1 second. What do you think about semiconductor stocks? So semiconductors remain very strong. They did look a little weak on Friday. So AMD, down down a little bit after the markets rallied 1.5%. So that's a little concerning to me, telling me that we've kind of hit a bit of a resistance here on some of these stocks. Consumer spending, online electronics is one of the few categories that we've seen an increase in spend, which is supportive of stocks like AMD that provide a lot of the chips for, your electronic devices and things like that. So that's why this stock is so strong. But price action on Friday for me is a little concerning for, continuing that long position. You talk negative on oil. What about the possible talks? I don't know that I'm negative on oil. I'm negative on the energy sector. I'm just going off of where the oil prices are trading after all these talks about, Russia and Saudi Arabia coming to the table, agreeing to that. The oil popped, $4 or $5. Now it's trading right back below to that pre-meeting level. Now you have Mexico coming in saying that they're not going to cut production. So just a lot of back and forth. And I think who's going to suffer are the energy companies, the U.S. shale companies that are only profitable if oil's back up to that $40, $50 range. We're not going to get back to that range anytime soon, and those are the companies that I'm way more negative on. How can I trade weekly options, and what are the levels of interest on this platform? I'm not sure what you mean by how do you trade weekly options? All options are tradable. You can trade weekly, monthlies. That's completely up to you. There's no difference in trading weekly versus monthly options. It's just what expiration date you choose and what levels of interest on this platform. So we don't discriminate. We trade weekly options, monthly options the exact same way because from our perspective, they are identical. The only difference is when they expire. For selling puts, do you recommend holding the put to expiration or buying it back early? So selling puts is one of the only strategies that I recommend that as long as you want to own the stock, continue to hold on to that put. Hold it through expiration. The only time that you might want to get out of a put early is if the stock rallies significantly and you want to own that stock. Then what you might want to do is you want to buy back that put, sell a higher put. That's really the only time where you would touch a short put, in my opinion. Tony, a lot of researchers say that we didn't see the bottom yet in the market. So, I will say that was I completely agreed with that sentiment up until, the Fed coming in with another $2.3 trillion of stimulus. It's hard to fight the Fed. And the Fed, in my opinion, is doing the right thing. They are backstopping, what is going to be a very, very tough economic recession that we're heading into. There's no questions about the fact that we're heading into a recession, and it's going to be quite significant. I mean, you've seen the employment numbers that I've shown you. We have never seen 14 million unemployed in the matter of a few weeks. The highest we've ever seen in unemployment claims was 700,000, and that took months to lead up to that number. The Fed had to make these huge moves to backstop the markets, and the equity markets are showing that they that they like it. So you never want to fight the Fed, and during this when we broke out above 302, I remember on January 1st, on January 2nd of 2020, I was on CNBC on Squawk, and they asked me, where do I think the markets are going to be? And I said that things are, we've had this pretty crazy rally, here, that we were going to get a pretty big correction. And they asked me, when did I think that was going to happen? I said around February, March. I'm sorry, I think I said January, February. And throughout the rally in February, I kept saying to myself, there's no way in hell this market can continue to go higher. But it just doesn't make sense for the market to continue moving higher. You didn't see earnings growth. We just had this multiple expansion. Stock buybacks are starting to slow down. Why was the market continue to move higher? It was because the Fed was easing during that time, and you don't want to fight the Fed. Is the lesson here. So I agree that most research say that we haven't seen the bottom yet, but those are based on the fundamentals, right? And the fundamentals, from my perspective, do not line up with the markets rallying, as far as they did. But when the Fed steps in, all of that kind of goes out the door. APT, I'm not familiar with that stock, Michael, so I unfortunately don't have a lot to offer that. Q's 152 call calendar. Michael, I'm not sure which trade you're referring to there. Thank you to everyone. What about Nvidia? Let's take a look at Nvidia. Similar to that AMD, right? Meaning the chips very strong throughout the sell-off, very strong throughout the rally, but over the last couple of days have started to slow down. I wonder if this is a case of people saying that there's only so far this can go. We really see that the economic recession that's coming out is going to affect consumer spending. It's going to affect these specific industries. Semiconductors, extremely sensitive, in my opinion, to consumer confidence and numbers. So perhaps this is a little forward thinking from the consumer, from the semiconductor space as to what's going to happen. What charting and scanning platforms? So I use OptionsPlay and TradingView for my charting. As far as scanning, we pretty much built everything ourselves in-house. Happy Easter, Good Friday to everyone. What do you think about D? Dominion Energy. So utilities, extremely strong. I think utilities is a great buy for the dividend. I don't think you necessarily buy it for the capital appreciation. Going into the recession that we're about to head into, utilities is one of the places that I would buy, but keep in mind that we've already rallied, 25% off those lows. I don't think you're necessarily going to see much in terms of capital appreciation going forward, but paying, many of these pay 4 or 5% dividends. Those dividends look like they're going to be stable. We don't expect there to be a lot of dividend cuts in this particular market, predominantly going to be in the energy space that we're going to see any dividend cuts. I think the expectation is about 8% of companies in the S&P 500 are going to cut dividends, of which I think 5% of that is energy. So utility is certainly one place to get some yield at the moment. Do you think Qs have room to grow? If you look at the tech sector, not particularly strong, not a strong showing here on Friday, basically flat on the day when markets are rallying. I think that tells me that technology is waning in terms of much room to grow here. Thoughts on SLB? I'm not familiar with SLB. I don't follow SLBs particularly, but again, I think this is one of these names that is really going to continue to suffer in the next few months. The whole energy sector, I don't have a strong opinion. I don't have a strong feeling on that particular sector. Do you use calendar spreads or cover call put? So we use a lot of call calendars. I'm not sure what a cover call put is. If a cover call put is a collar, occasionally I do, but I rarely trade collars myself. What do you think about Apple? Interesting. I think Apple just trades with the market. I'll be honest, Apple being a fairly consumer company, I think is going to have a tough time continuing to grow at the pace that they have. I don't think streaming is going to make up for the losses in iPhone sales. I mean, the conservative estimates from a couple of weeks ago on CNBC last week was about a 15% decline in iPhone sales, which would put you, if you had the same growth trajectory and you had the same strong economy that we were in, then I would say that the stock is fairly priced. But a 15% cut to iPhone sales, and you're going into a recession, and not just a US recession, global recession, I don't particularly like the outlooks here. But again, I don't think it makes a lot of sense to fight the Fed and go out and short stocks like Apple. I think you're better off selling credit spreads and say that there's limited upside here. And as long as Apple doesn't continue to rally back up to 300 and 310, you're able to profit on this. And that's the type of trade that I think Michael Coe brought, was trying to say last week on some of these types of names. Thoughts on AYX? I'm not familiar with AYX, so unfortunately I don't have a lot to comment there. Oh, skew. So skew is just a plot of the implied volatility of an option. So it's, a lot of softwares have this. I use Thinkorswim. This is what I use here for this particular chart for plotting skew. Chuck, who just left, has a really good comment in this particular case, saying, does the skew tell us where it's going to go? And the answer is not really. The skew is just telling you where options are priced. People have bought a lot of the in-the-money calls. People have not bought a lot of the out-of-the-money calls. And that might be some indication that there's not a lot of demand for these out-of-the-money calls, which means that people are not as bullish on Microsoft. And people buying more of the out-of-the-money put options are more bearish on Microsoft. You can read it that way, but I would be hard. I don't think you should necessarily make that judgment all the time, because I think there's a lot of times that, put call skew is just out of whack for various reasons that don't necessarily mean that the markets are heading in one direction or another. Joel, I think we already covered this, the Spider 255s. I would be selling, puts against that. Yes, absolutely, turning into a calendar again. I think we've already covered AMDs, cruise lines I've talked about. If you're looking to generate consistent income, which is a more profitable selling strategy, selling cover calls or credit spreads? Cover calls by far, because you're getting the full premium. When you're selling a credit spread, you're paying a decent portion of that premium back by buying that out of the money credit spread. The difference is that a credit spread doesn't require you to own the stock. So it's hard to compare the two, because one requires a stock, the other one doesn't. USO, with all the oil news, USO has not been a great performer. It continues to, hang out around this $5 level. I looked at buying some call options on USO the other day, but they're just so expensive. I don't think it makes a lot of sense. GDX versus GDXJ. I'm not familiar with GDXJ. What is GDXJ? Junior gold miners. Just looking at the price action, I think GDX is a little stronger. Yeah, see, GDXJ hasn't made it past that support level. GDX has, just on a relative strength basis, I would go with GDX. Jack asking the question about trading weekly options again. Again, there's no difference in trading weekly options versus monthly options. You just select expiration dates that are non-week. Again, I don't think you should think about weekly or monthly options. Choose the expiration date that matches your time horizon and just trade it. It doesn't matter whether it's a weekly or monthly option. That's just something we call it, but the options are all the same. Would you do a leap on Boeing? So, my views on Boeing are the same as are mine on the airline industry. I think Boeing has, in my opinion, a lot of trouble with the 737 MAX, getting that off the ground. We've seen a lot more cancellations on that particular airliner. If I was to take a flyer here on Boeing, I would use a call calendar, or call diagonal rather, where I buy a longer dated call. I mean, I think, there seems to be a lot of, I wouldn't want to say research. I would say a lot of analysts who feel that, Boeing should be trading back up in that $200, $300 range in the next couple of years, because it is a fairly integral part of our economy, and that the government and will step in and save this type of company, and certainly would never let it go belly up. But I think that, in my opinion, where it's currently trading is more fairly priced than back up in that $300 level. I think it stayed in that $300 level a lot longer than I had anticipated. I think trading in that 150 level is a much more reasonable valuation for a stock like this to be trading. How can you calculate relative strength like on E-Trade? So this is a proprietary calculation, so I don't know how you would get it on E-Trade. E-Trade might have their own proprietary or their own relative strength indicator from another provider. So I unfortunately don't know how to do it on E-Trade. I apologize. Wow, still so many questions. I'll try to get to a few more. I know we're already running quite a bit over here. Where can you find the past recordings? They're all on YouTube. I posted a link before. Can you set up recovery strategies on options? So recovery strategies are more so on stock positions. As far as recovery strategies on options, my philosophy is ask yourself, if you weren't already in a losing position, would you get into a new position on that stock? 9 out of 10 times the answer to that question is no. And if the answer is no, you should not try to repair that option strategy. If the answer is yes, then what you should do is you should close out your first losing trade and get into the brand new trade as if, again, you weren't already in a losing trade. And ask yourself, how would I structure that trade? That's how you should think about any type of quote unquote repair options trade. It would be nice to indicate the technical strength score on your cover call at cash secured put report. Interesting feedback, Rick. I'll take that back to the group here. How can I download the Excel sheet that you're sharing? You should be able to just go to File and Download. Or open in desktop app. There's definitely a way to download this spreadsheet. But you can download it, but it updates every single day. So if you download it, you're kind of behind on it. So I think that you're better off viewing it on this browser. What would you recommend the maximum amount to be paid for long calls? Generally, when you exceed more than 5%, that's when I think you need to start thinking about it, unless it's a really volatile stock. Pretty much anything that's very liquid, I would say in the 5 to 7% is probably on the higher end that I would pay. Stephen, thank you so much. I really appreciate it. Based on what you said, what do you think about Bud? I don't have a lot to add on Bud and Anheuser-Busch. Wow, Anheuser-Busch is significantly weaker than Constellation. So, maybe this stock has a little bit more upside. It looks like it's just breaking out above that $46, $47 level. So maybe this stock has a little bit more upside, close out some of these gaps, 53, 60. I think you might get a little bit more of a rally here on this particular stock, but it does have very weak relative strength. Certainly doesn't have the same exposure, but the weak relative strength for me, I think, is a non-starter, especially compared to Constellation. I think I've looked at Apple comments on Zoom. Zoom stock actually yesterday was up, right? So I think the CEO did a decent job of addressing the privacy issues. I think what's really to see as to how they actually fix it in the next couple of months. Zoom normally does 20 million meetings a day. They've recently hit 200 million meetings a day. Obviously, a lot of those are free accounts. They're not necessarily going to convert to paid accounts, but I think that they're going to see a significant growth in their business in the next few years, especially since I think people are going to reevaluate whether or not they need to necessarily go into the office every single day after all of this. People probably find that they're a little bit more productive when they're at home, when they don't have a lot of distractions, when they don't have to spend 2 hours of their day commuting. So I think those are interesting themes for a stock like Zoom. Please comment on MasterCard. So MasterCard and Visa have been doing okay. You know, they recently announced that they're likely going to increase fees, which is probably going to provide a temporary bump on these particular stocks. But again, you know, they're trading around these major resistance levels that I'd like to see them break out above. You know, until they break out above, I'm more of a neutral view on these types of names. You know, they tend to be somewhat shielded from recessions, but you know, we have seen about a 30% decline in credit card spend, so not great for these particular stocks. What other instruments than GLD would you suggest to bet on in future inflation environments? Some of the treasury like tips, you know, might be something that you might want to take a look at, but generally GLD is the one that I would use. I've seen a lot of backward head and shoulder patterns. Do you think they're reliable in the short term? Absolutely. I think head and shoulders are a great sign of a bottoming formation. You kind of have one here, a little bit on Microsoft, MasterCard here, not a particularly strong one, but absolutely, head and shoulders can be used as a bottoming pattern. Your comments on IBM or Pfizer. So IBM, you know, I don't particularly think IBM has a strong business, you know, going forward here. But I don't have a whole lot to add on IBM, to be perfectly honest. What about Canadian banks for dividends? Canadian banks have been holding up pretty well. I'm sorry, Canadian banks I think are in a similar category as U.S. banks. They're trading below book value. They have strong dividends. Strong balance sheets, which means that I think their dividends are likely going to stay. I do like Canadian banks as an investment longer term. Yeah, we will get some insights into semis next week. Can you comment on how the recession will impact us? I think it will impact us on so many different levels that we cannot even imagine at the moment right now. You know, 14 million unemployed is going to make it very difficult for a lot of small businesses to stay open. I think you're already seeing a lot of, I think you're going to see the restaurant industry hit pretty hard, travel industry hit pretty hard. I think consumer industries are going to be very slow in getting back on their feet. It's not going to be easy for a lot of these smaller consumer stocks, smaller consumer names get to continue operating in the next couple of years. I think you're going to have a shift in terms of how people work, how people, the fact that we are, you know, working relatively well for the people that are lucky enough to be gainfully employed during this time. You know, I think we're going to shift a little bit more to more remote work, which obviously benefits some technology companies. If we look at the environmental impact that you know this shutdown has had, we've seen some really interesting trends in terms of pollution. I think that you might see some interesting trends in the environmental space, even in the food space. This is going to shake out some of the weaker food producers as well. We've seen a lot of reports of, you know, dairy farms going under because you know, we simply cannot process the amount of milk that's being produced. So there's going to be huge shifts in this market that, again, I don't even think that we can't even imagine at this moment. Can you comment on Costco? Costco trading at roughly, you know, the thing about Costco here is that Costco predominantly generates most of their revenue from memberships, meaning they don't actually generate a lot of revenue on goods sold. So even though you have a strong uptick in terms of stocking up and people buying their foods from Costco instead of going out to eat, it hasn't performed as well as supermarkets like Kroger, which makes more of their money on the cost of goods sold. So Costco, I think, is more neutral for me. I think it's certainly going to stay relatively strong, but I don't see a lot of upside there. Do you think we have another drop in the market? What could possibly be the catalyst to make that happen? I think the catalyst would be earnings. If these companies, you know, start providing a little bit more, you know, a lot of companies have pulled guidance, right? So basically we have a complete vacuum as far as what's what their numbers look like, how they are going to provide guidance as they report, as we go into the next few weeks, as more companies report earnings and then provide a little bit of guidance. That, in my opinion, could be the catalyst that we see some significant drops from some names. And I think there's going to be more downside risks than upside risk going into this. TLT is similar to the LQD trade, very strong. I think TLT probably has a little bit more strength left to go. It's basing around this 160, 165 level. I think it might be able to make another run higher. Is liquidity different between weekly and monthly options? No, it is not, because from a market maker's perspective, it doesn't matter whether they're making a one week option, 2 week option, 3 week option, 4 week option. Liquidity is the same. It's really when you go really far out, like 2 years, that's when liquidity drops off. But the weekly, the monthly options, there's really no difference in terms of liquidity. Does OptionsPlay have a way to get more aggressive on the trades? I'm not sure what you mean by get more aggressive on the trades, Carrie, if you don't mind clarifying. Okay, so I've been on for an hour and a half now. So thank you so much for taking the time out here this afternoon. This morning rather. I really tried to get to as many of your questions as possible, but again, there are so many questions. Thank you so much for taking the time out here every single week, submitting your questions, listening to us talk. I'm glad that I was able to spend some time with you today when the markets are closed, answering more of your questions, answering more of your thoughts and ideas. We really want to continue doing this with you guys to continue sharing ideas and giving you guys the different thoughts that we have here in the markets, and continue to provide guidance as far as how we're positioning in the markets. Because I think communications as far as what we think and also listening to your thoughts in the market provides us with a lot of the themes that we place in our daily plays. And I hope that this is useful for you guys in terms of setting up your week. I hope you guys all have a great Good Friday. Happy Easter to everyone. And I'll see you guys next week on Tuesday morning's Outlook. And then Thursday afternoon, we'll be doing our special event on earnings season. So thank you so much. I hope you guys have a great day.